Hey guys, hope you had a great weekend. Kicking it right off with the economic data for this week. So I know I have the first solar chart up right now, but important data coming out on Wednesday. We have CPI data month to month coming out, as well as core CPI and CPI year over year, as well as core CPI year over year. So Wednesday morning, 8:30 a.m. That should be a volatility inducing event. And then we also have the beige book at 2 p.m. on Wednesday too. So keep an eye for broad markets on Wednesday, not Tuesday, Wednesday. And yeah, and delving right into individual names, I had spotted First Solar last week, had a nice little tumble down to 80 level, and it recovered up to 84.60 on Friday. So keep an eye on First Solar. Not a bad name to look at longer term, as you know, we move toward a clean energy society. It's sold off pretty heavily in the last couple of months. It's down about 35% or so, 34% at the lows, and the low is 80. As you can see across here, support was broken obviously at the 95 area, and now next level support would be, I guess, the lows of 70 or so. So if we pull the option chain and look at for solar and analyze what could possibly be done on it via options, we can see some ideas. And here's the option chain. So, so going out with a bit of time, IV is low right now, 42.9% versus a historical of 52%. If we go out a few months, let's say we go to March or even June, if you want to play it longer term, looking at March, 68 days away right now, CSPs don't yield too much, cash secured puts at the support area of 70. I mean, you're getting like $1.73, $1.75. So it's not that exciting overall. And liquidity isn't that great over here. Spreads are a bit wide, not insane. But if you go at the money and you don't believe it's going to break below 80, there's a decent premium to be had there. But keep in mind, this is for March, which takes past earnings, and also 68 days till expiration, right? So that's a lot of time to wait for cash secured puts to pay it out. If you're bullish on this, which I think is the right move longer term, like we're looking at, a few months out, I think June or July would be better. So looking at June, for example, the 95 long wouldn't be a bad idea, and then leg into a call spread perhaps, or you could even do calendar spreads where you buy the out of the monies for June and you sell against them, straight calendar spreads, right? But then you're risking losing whatever your overall debit is. So for example, if you were to buy June OPEX 95 strike, and then look at, for instance, February 95 strike, you're getting $1.70 or so, $1.60 or so over here. So your debit aggregate goes down to about $4.50. That's your maximum loss over the next 40 days. But then if it rallies above 95 by February OPEX, that's when you need to take a loss perhaps, right? Alternatively, if you liked the idea on owning it at 80, you could sell the March OPEX 80 strikes for 450 or so right now, and then use that premium to buy longer term June 95s, right? Your net debit over here is about $2 or so, right? Sorry, $1.50, right? But this is an ultra bullish strategy, basically a risk reversal on different dates. So, you have double exposure on the downside into March, given the CSP for March OPEX, plus the long call for June OPEX, right? I just noticed the chart, it's pretty oversold. I think it can easily bounce back up to, 95, 100. Looking at the chart over here again, let me just pull it back up. So, where'd it go? Yeah, so again, looking back up over here, right? If we can reclaim 90, then it could easily push back to 100, even 106 or so. That isn't a bad level to get out at, right? So, right now, good ideas are few and far between, given that we're seeing a rotation out of growth names into value names. And just as evidence of that, if you look at any stock that pays a good dividend, for example, AT&T, right? AT&T has rallied from a low of 22 on December 15th to now it's $26, right? It's up. Sorry, let me draw the line again. It's up about 20% in less than a month. Look at, for example, ExxonMobil, right? Same thing. From the low on December 20th, it is now up 20%, right? So what we're seeing here is a pattern where funds are rotating into safer assets as we approach rate hike, a market with rising rates, right? So last week we saw the Fed release some minutes, and that spooked the market. We had 4 red days in a row from Tuesday to Friday after a green day on Monday, and we're going to see a lot more turbulence in the market, I would say, going forward, given that we could see much faster rate hikes than predicted previously. And again, that would mean that cash flows of corporations that are in the growth areas would be discounted at a higher rate, meaning their cash flows are worth less right now. Actually, future cash flows are worth less overall, meaning that their valuations are overinflated right now as well, right? So that's why you're seeing those names sell off. Don't be too eager to dive into them, because they can get much cheaper, especially as we head into the middle of the year and the end of the year. I know it doesn't seem like it's that far away right now. June, July, mid-year, and then obviously end of the year, we could see 3 or 4 rate hikes before we're out of 2022, and that could cause the market to stay relatively flat overall, right? So if you're looking for yield, dividend yield stocks like XOM and AT&T aren't a bad idea, but growth names right now are kind of out of favor, as we can see. So you want to be very patient with what you buy, right? One name I do like, obviously, and I mentioned it a few times almost every week, is PayPal. Last week, even amidst the selling, it was holding up pretty nicely. So you can see just the 1 week chart. Monday, market was very green. Tuesday, we were red. Wednesday, red. Thursday, red. Friday, red. And on the week overall, we opened the week off. Here's a 2 week chart. So we opened the week off at 188.66, and we closed the week off at 188.07, right? So given that the broad market, that being, so NASDAQ, for example, right? It fell from the previous Friday close. It fell about 6% or 5.5%, and PayPal was pretty much flat on the week. And also the consolidation we were seeing in PayPal as well, which I just pulled up, right? You can see that on the 1 year chart, we're consolidating heavily in this range between 195 and 180. Now, the longer we base here, the more powerful the move will be whenever we do move, right? And I think we see a gap fill at 230 area. Now, whether or not earnings is a catalyst to that, and earnings are early February. So that could be the catalyst to move us there. But who knows, right? You want to look for value here, and the valuation on PayPal is very reasonable. I won't delve into any strategies right here, because obviously, you can do what you want to do, whether it be cash secured puts, call spreads, right? You can do, butterfly call spreads if you want to reduce your risk a little bit and have, a lower debit, but there is inherent risk in that strategy in and of itself as well, right? One other mega cap that's undervalued too is Facebook. Even though I hate the business overall, because I believe it kind of, ruins society, they are undervalued by looking at their price earnings ratio, right? So if I look at their ratios right now, currently forward price to earnings ratio of 23.32, price earnings ratio currently 23.72, valuation 924 billion, and sales are 112 billion right now. So price to sales is 8.23. You contrast that with like Google, for example, right? Google is trading at a valuation of almost $2 trillion, right? Granted, they are doing more than double the sales of Facebook. So I guess valuation is pretty similar overall, but I like Facebook over Google in the longer term, given the valuation. Otherwise, looking at broad markets, we'll pull up some option chains here, look at expected moves. So NASDAQ right now is sitting, let me see, one second, here it is. NASDAQ right now is sitting at support 380 area on Qs. And if we break below that, which I think we will break below it, next level of support would be previous all-time highs right around 370 area, right? So support would be right over here, next level. And obviously, if we break below that, the next level of support would be previous all-time highs right over here at 342 or so, right? So The downside could be pretty steep on big tech names. Looking at, like, for example, if you see downside from the current level, 2.2%, if you see 370, and if you see 350, that would take, 340, that takes us down 10%, right? So that would be a pretty large correction from the all-time highs. All-time highs down there would be a correction of about 16%, which we haven't seen in a while. We've seen a few 11% and change corrections, but nothing in that magnitude prior to the COVID lows of March 2020, right? So what I'm saying is be conservative and be patient in your buying. And if you are going to be buying, big tech names, perhaps buy in smaller lots and scale in, and make sure to buy time, that being buying the equity or buying contracts that expire 6 months to 12 months out. Being short term in this market, especially with implied volatility higher, you're paying a lot more premium and you can get burnt pretty damn fast, right? So look for value names that you believe are cheap right now. Like, as I mentioned, PayPal, Facebook could be some names, but if you want some dividend income, there's AT&T, XOM, Con Edison, for example, also SCWD, Starwood Property Resorts. There are a variety of them. If you pull up your scanner and just sort by large caps, anything over 10 billion, and look at highest dividend payouts, and then obviously look at the history of dividend payouts, and ensure they've been paying them for a long time and that they have the cash flows to actually sustain those payouts. Those are names to keep an eye on, right? Otherwise, looking at SPY now, so SPY, it had a rough week as well. Not as rough as NASDAQ, but it still fell on the week about 3%, 3.2%. Again, support would be at 450 now on SPY, and if we fall from the all-time highs, that would be a decline of about 6%. From the current level, that'd be a decline of about 3%. So nothing crazy, but again, with CPI data coming out on Wednesday, could see some volatility, and that could see us pull down to that area right now. Right, as I speak right now, futures are flat, so hard to really telegraph tomorrow's open, but it doesn't look very bullish overall. If anything, it'd be neutral to bearish the next little while until we see direction on rate hikes, and I think we're going to see numerous rate hikes pretty fast because of inflation, right? Obviously, some of that's due to supply chain shortages, but there is inherent inflation due to the wage price spiral we're experiencing now, where workers are demanding higher wages because of inflation, and consequently, companies will have to raise prices, and that means that we're going to be paying higher prices for other goods and services too, right? So that's part of it as well. The other one I want to mention too is the Russell, so IWM. Again, we sold off on Tuesday, Wednesday, Thursday, Friday last week after a nice Monday, and we are still below that gap fill area at 228.54, back from 11.24 last year. So keep an eye on that. I would say Russell's or small caps would be probably a better area to be, given that the valuations can be much lower, not in terms of like being cheap overall, but for example, looking at like CRISPR or Editas or Intelia, gene editing stocks, right? The valuations aren't insane. You're seeing these companies that could be part of a $1 trillion market that are worth $5-6 billion, right? They have a lot of room to the upside if someone wants to acquire them, for instance, right? Like you look at CRISPR as an example, CRSP, and they're trading at year lows right now, basically. And in the last couple of years, we've seen a high of 220. So from the high to where we are right now, we've seen a decline of 71% or so, right? That's a massive decline from highs. Even if you go to the previous highs prior to that, looking at like the 105 highs from August, that high to where we are right now is still a decline of 37% or so. Pretty steep discount on a company that is revolutionizing the biotech sector, right? Among others, as I mentioned, Intelia, NTLA, Beam Therapeutics, BEAM, Editas, EDIT, Fate Therapeutics, FATE, right? There are a number of other names as well, right? But yeah, so again, just play cautious, maybe wait till Wednesday to see what happens. We could see some serious volatility into that event, 8:30 a.m. Wednesday morning CPI data. And obviously play longer term, if you must right now, and be patient, scale in. Don't dive in head first, because the market we've had the past couple of years after COVID lows in March, that market may have sailed, and we may be entering a new market or a new phase wherein buying the dip no longer works, right? So you want to be very cautious going forward. You want to protect your capital, and especially as rates go up, right? Because as rates go up, capital is more precious, right? So keep that in mind as well. If you have any questions at all, drop them below. I'll respond when I can. Otherwise, have a great week, and we'll do some Q&A right now.